Yeah, I think it makes sense to expect average higher domestic inflation because of industrial policy. The rest of the world sees that, and they see a couple of variables. One is that they see the weaponization of the dollar. So they say our reserves are freezable if we're not on the right side of the US. And two, they're saying that, when push comes to shove, they're going to print the money. And so holding low yielding debt that is not, for literally our national savings from their perspective is not really like a, sound, prudent financial policy to follow.
In this insightful analysis by Lyn Alden, we delve into the shifting dynamics of global finance. Alden highlights key factors driving the average higher domestic inflation, notably the weaponization of the dollar and the implications for countries like BRICS. Despite efforts to diversify away from the dollar, BRICS nations face challenges due to the unparalleled depth and liquidity of U.S. capital markets. While bilateral trade agreements and alternative assets like gold and Bitcoin offer partial solutions, the process remains piecemeal and slow-moving. As a result, Treasury demand decreases, potentially leading to increased financing of the U.S. deficit domestically.
Now, there are significant network effects with the dollar, right? So I think some people overstate how quickly BRICS can change from that model. And, as an example, any country that prices its global contracts in dollars and collects dollars, there's a lot of things they can do with the dollars. The U.S. has the deepest and most diversified capital market, so they can put it into virtually any equity they want. They can put it into the very deep and liquid bond market. They can put it into private equity. They can put it into real estate. There's a lot of liquidity and size and diversity they can put those assets into. Whereas, for example, if Russia and India make bilateral trade agreement so that Russia sells oil to India in rupees, and Russia starts accumulating a surplus of rupees, there's only so many things that they want to do with rupees. Eventually, they say, okay, we have too many rupees now. Can you pay us in something else? And that's an example that's come up a number of times. And then, if they make a deal with China, if they make a deal with Brazil, if Brazil makes a deal with India, or Brazil makes a deal with China, you have these kind of bilateral trade agreements, and none of them have the individual liquidity or depth of markets that the U.S. has. And so they have to figure out how to tie those together better. The only one that even comes close would be China, because there's so many things you can buy if you have Chinese currency, but then they have closed capital markets. And so they have way less liquidity and way less, kind of security in that regard. And so the problem that BRICS it goes through is that they have to deal with this kind of piecemeal, weaker network effect of multiple different currencies. They don't really want to put their currencies together in the same way that the Eurozone has. And so, there's kind of a mismatch of solutions. Some of the bigger ones do these bilateral trade agreements to kind of reduce their reliance on dollars on the margin. They can put surplus reserves into gold. They've been doing that because that gives them an unfreezable, debasement-resistant asset that they can hold. You've even seen some smaller countries do things like mine Bitcoin or accumulate Bitcoin. So El Salvador, the Kingdom of Bhutan, we're seeing mining now in the Emirates. So some of them are kind of saying, okay, here's this asset that we can hold. We can also make global payments with it. So they're kind of exploring that around the details of small positions. So all these kind of ways to say, okay, how can we circumvent the dollar? How can we build bridges between our different bilateral trade things to make this more efficient? Things like M-Bridge allows kind of, this kind of the CBDC version of their global trade settlement to kind of all interconnect rather than all go through dollars, all go through New York. But that's kind of the slow grinding piecemeal process that's playing out. And around the margins, it reduces treasury demand. It makes that so that more U.S. deficits have to be financed by domestic sources. So either the banking system or non-bank financial entities or the Federal Reserve in some cases. And that's overall, it adds to the average inflationary backdrop that we can expect.
Lyn Alden's insightful analysis continues as she delves into the evolution of typical investment portfolios amidst changing economic landscapes. Traditionally, portfolios have been structured around expectations of disinflation, with a heavy reliance on stocks and bonds. However, Alden points out that this approach may no longer be as effective, especially considering the recent shift in interest rates and equity valuations. Instead, she advocates for a more balanced mix of assets, including inflation-protected securities like TIPS, gold, and investments in sectors that thrive in inflationary environments, such as energy and diversified industrials. By diversifying portfolios to include assets that perform well in various economic scenarios, investors can better position themselves for uncertainty and potentially mitigate risks associated with prolonged disinflation.
When we think of the typical portfolio, like the 60-40 stock bond portfolio, that's a portfolio that's entirely geared around the expectation of disinflation. So it's expecting inflation to be low and asset prices to be pretty positive. And so during that 40 years, stocks were mostly up. During recessions where they went down, bond yields would usually go down, so bond prices would go up. And you had 40 years of declining interest rates, 40 years of kind of steadily declining inflation. And so higher stock valuations, higher bond valuations, it's all kind of a positive feedback loop until it's not. And so now that, interest rates have kind of hit zero and bounced off zero, and now that equity valuations have kind of inclined higher for 40 years, I think a lot of the juice has been squeezed out of that positioning. And that a lot of the kind of statistics around that are basically recency bias, looking at the past 40 years and just expecting them to continue without really having a reason for why they would continue. And so I think, the way that I approach it is to say, okay, I still want to hold equities, I still want to hold other assets, but I want to have more inflation protection within a typical portfolio. I don't want to be geared entirely around the idea that there's going to be another 10, 20, 30, 40 years of structural disinflation. And so instead of that kind of 60-40 stock bond portfolio, say, okay, we have a stock section. The bond section could be tweaked. It could be, for example, shorter duration, cash equivalents, T-bills, money markets, things like that, tips. You can put gold in place of some of the bonds in that portfolio. And you can break out a section that's kind of geared towards inflation. So, for example, energy producers. Other types of real assets, maybe copper producers, for example, diversified industrial plays, things that are more in line with that inflation scenario. And so instead of having the entire portfolio geared towards disinflation, you've got that more balanced mix of some assets that prefer disinflation and growth, some assets that do well in those more stagflationary, inflationary environments. The cash equivalents can hold well against market sell-offs, and you have kind of various debasement hedges. I think that more balanced multi-asset portfolio makes more sense when you have that less of that Goldilocks scenario.
Today's discussion with Lyn Alden has shed light on crucial insights into the evolving dynamics of global finance. We've explored the ramifications of the weaponization of the dollar and the challenges faced by BRICS nations in diversifying away from it. Additionally, Alden provided valuable perspectives on portfolio construction, emphasizing the need for a more balanced approach to asset allocation in anticipation of potential shifts in inflationary trends. Remember to hit the subscribe button to stay updated with our latest content, and don't forget to like and share this video. We appreciate your support and encourage you to share your thoughts in the comments section below. Until next time, happy investing.